Strong governance means higher stock prices over time. Good governance fosters investor confidence, attracts capital, and supports sustainable business practices, leading to better financial performance and stock price appreciation. Who runs companies and how good governance protects investors' interests is crucial because it affects stock prices. By the end of this video, you'll have a better understanding of key questions to consider when researching a company for investment purposes. First up, let's talk about the board of directors. They're like the captains of the ship, making all major strategic decisions for the company. Now imagine if these captains were more interested in sailing around aimlessly than steering the ship towards profit and growth. That's what can happen with poor corporate governance. Good corporate governance starts at the top. A board that prioritizes shareholder interests over personal gain helps maintain transparency and accountability within the organization. Think of it like this: a well-run company operates like a well-oiled machine where every part works together smoothly to achieve its goals. In contrast, poor governance can lead to inefficiencies and conflicts, much like gears grinding against each other. Let's look at a real example. In 2018 and early 2019, Boeing faced major issues with the crashes of its 737 MAX airplanes. The board was criticized for not addressing safety concerns early enough and instead focusing on short-term profits. This led to significant financial losses and a sharp decline in stock prices. Contrast this with Apple, where strong governance under Tim Cook's leadership has kept the company focused on innovation and long-term growth. Now let's dive into some numbers. According to research by McKinsey, companies with better corporate governance outperform their peers over time. For instance, from 2010 to 2015, companies in the top quartile of governance had an average annual return approximately 5 percentage points higher than those in the bottom quartile. So how do you spot good corporate governance? Start by examining the board members. Do they have diverse backgrounds and a range of experiences? Are they truly independent from major shareholders or management? Additionally, look for transparency. Does the company regularly provide updates to investors about both its successes and challenges? Now let's talk about expenses. Companies with poor corporate governance often allocate more funds toward executive bonuses and less toward shareholder dividends compared to well-governed firms. A study in 2018 revealed that companies in the bottom quartile of governance spend an average of $3.5 million more per year on executive compensation than their better-governed counterparts. Here's another angle. Insider trading activities can provide insights into corporate governance. If top executives are selling significant amounts of their company shares, it might be a red flag indicating concerns about the company's future performance or internal issues. Conversely, if insiders are buying and holding onto more company stock, that typically signals confidence in the company's prospects. Now let's look at an example closer to home. Imagine you invest $10,000 in two companies, one with poor governance and another with strong governance. After 30 years, the difference can be staggering. Assuming a lower average annual return for a company with poor governance of around 5%, your investment might grow to about $43,220 due to compound interest. But if the company with strong governance provides an average annual return closer to 10%, it could balloon to over $174,494. That's a gap of more than $131,274. Now let's discuss how you can protect yourself as an investor. First, do your research by examining annual reports and proxy statements to assess the quality of corporate governance at a company. Look for strong internal controls and independent directors who are willing to challenge management when necessary. Second, be wary of excessive executive compensation without clear performance justifications. If executives receive large bonuses or salaries while the company's financial performance is weak, it can be a red flag for investors. Third, monitor insider trading activity. When insiders buy stock, they're making a personal investment in the company, which can be seen as a positive signal. Here's another concrete example. Think about a company with strong corporate governance like Berkshire Hathaway under Warren Buffett. The company consistently focuses on long-term value creation and maintains minimal executive perks. In contrast, some companies have weak governance where executives receive excessive benefits at the expense of shareholders. Now let's talk about broader implications of poor governance. It can lead to risky decision-making and short-term thinking, harming both shareholders and the company's reputation in the long run. For instance, Enron's collapse in 2001 was partly due to a lack of transparency and accountability within its boardroom. In contrast, companies like Johnson & Johnson have maintained strong governance standards throughout much of their history, contributing to consistent performance and positive shareholder returns over many decades. So how does this translate into analysis? When evaluating a stock, consider these factors. Are the board members genuinely independent? Is there transparency in decision-making processes? Do executives' interests align with those of shareholders? For example, let's say you're considering investing in a tech company. Review their proxy statement to see if the CEO is also a major shareholder. If the CEO holds significant stock, it suggests their interests may be better aligned with those of other shareholders. Now let's take this one step further. How do these principles apply to real-world scenarios? Imagine you're considering investing in a promising startup. The founders have impressive backgrounds and the company is growing rapidly, but there's no transparency regarding how funds are being allocated or who holds decision-making power. This lack of clarity can be a red flag for potential future issues in corporate governance. Instead, consider investing in startups that have transparent communication channels with their investors. Here is another real-world example. Tesla faced scrutiny over its board composition and executive compensation practices around 2020. The company responded by making changes to enhance transparency and governance standards, which helped boost investor confidence and positively impacted the company's stock performance. Remember, good corporate governance isn't just about avoiding pitfalls. It's also crucial for seizing opportunities for long-term growth. It's like the difference between running a marathon with worn-out shoes versus well-fitted ones. While the worn-out shoes might seem less costly initially, they could lead to injury and poor performance over time. Let's recap. Good corporate governance is crucial because it ensures that all stakeholders are aligned toward long-term success. This leads to better decision-making, increased transparency, and ultimately contributes to more stable and sustainable returns for shareholders. When evaluating an investment, consider the quality of corporate governance within the company. Assess whether the leadership prioritizes shareholder interests and operates with transparency and accountability. In short, strong corporate governance can protect shareholder value over the long term, while weak governance can erode it in ways that may go unnoticed. Now let's dive deeper into how poor corporate governance can impact an investment negatively. One major issue is conflicts of interest. For example, if the CEO also owns a company that supplies materials to your potential investment target, decisions might be skewed in favor of maximizing their personal profits rather than those of shareholders due to financial incentives from both sides. Another critical aspect is board independence. When a board consists largely of executives who are friends or relatives of top management, it may lack the necessary objectivity to provide effective scrutiny and challenge decisions. This structure can result in inadequate oversight, potentially allowing for risky behaviors that go unchecked. Transparency issues significantly affect stock prices as well. Companies that conceal information or offer vague details about their operations may be attempting to hide underlying problems. Frequent changes in financial statements or delays in reporting earnings can serve as red flags indicating possible mismanagement or fraudulent activities. Let's consider a real-world example, Enron Corporation. Known for its massive accounting scandals and deceptive practices, Enron's poor governance led to the erosion of shareholder value and eventual bankruptcy in 2001. The lack of transparency, conflicts of interest, and ineffective board oversight were contributing factors to one of the most infamous cases in corporate history. Companies with strong governance structures typically feature robust risk management systems, ethical leadership, and transparent communication channels. These characteristics create a stable environment conducive to long-term growth and attract institutional investors seeking reliable, low-risk investment opportunities. Subject: Impact of corporate governance on stock prices. Passage to fact check. Remember, good governance isn't just about avoiding pitfalls, it's also about seizing opportunities. A well-governed company is better equipped to navigate market fluctuations and pursue new business ventures without compromising ethical standards or shareholder interests. So when you're evaluating a potential investment, look beyond the quarterly earnings reports. Pay attention to how the company handles conflicts of interest, whether the board operates independently, and if they maintain high levels of transparency. These factors can significantly influence stock prices and protect shareholder value over time. This is educational and historical, not financial advice.